Hello everyone and welcome back to the channel. If you've been following the markets recently, you must have heard about the massive global stock sell-off. In this video, we're going to unpack exactly the causes of that sell-off and what you can do to position yourself against the risk that comes with such events in the market. Trust me, such events will always reoccur because the market is cyclical in nature. So there are strategies that you can employ as an investor, and it's a must that you know some of this information so that this might not harm your investment portfolio in the future. This is Money Matters and I'm your host Kenneth. Thank you for tuning in. Please support the channel, like the video, share and subscribe if you have not yet subscribed. A special thanks to all returning subscribers and viewers. Thank you so much for supporting the channel. Imagine then waking up in the morning and you find that your investment portfolio is down a couple of thousands and continues to plummet and you don't know what to do. This is exactly what is happening currently in the global markets, and there are a lot of things that are happening, and in this video we're going to look at some of the causes. Let's look at briefly at the causes before we look at strategies that you can employ to avert such risks. Okay, the first cause is weak economic data. We know that at the beginning of every month, which is every Friday of every month, the US releases a lot of data, which is the Fed Bank in the United States. One of those indicators that are released are the NFPs. There's a video that we did on the NFPs. Please check down below for a link to that particular video. Now, when the NFPs are released, they actually give information of what are called non-farm payrolls, which is an indicator, an economic indicator on whether the economy is growing or not. Now, in this case, they focus on jobs to see whether businesses, firms, companies are hiring on a month-to-month basis. So which means there is a comparison from one month to another. Now, if the data shows a decrease, it means, or on a speculative note, the speculation is that the economy is in a decline. So we have heard of late rumors of a recession in the US. It's been quite some time, and now we are beginning to see the impacts of that trickling down in each of the economies that are linked one or the other to the US. So basically, weak economic data means that the last jobs for August, which actually means that is the jobs for July, which came out on the 2nd of August, meant that there is a slowdown in hiring, and therefore this suggests that the US economy and other economies are on a decline. Therefore, because of that, the speculation is that companies and so forth will start seeing maybe declines in incomes and profits. So speculatively, people begin to shift their monies from stocks, maybe to gold, to forex or cryptos or whatever the case might be. So the stock market around the world is facing this massive impact from these withdrawals. The second one is corporate earnings. We've seen companies such as Apple, Amazon, which have been doing well for quite some time. Now there's a slowdown. We've seen their earnings coming a little bit down, and this also increases that speculation that the economy is on a downtrend. Now remember, we are talking about cyclical nature of the economy, and as such you need to anticipate such things if you are an investor. So if the expectation is that big companies are showing a slacking in terms of their earnings, the suggestion therefore for a lot of investors there is to move the money from the stock market, hence the massive sell-off that you're seeing currently. The third one is interest rate hikes. We've seen interest rate hikes in Japan, and this sent a lot of shockwaves through the market, and as such the global stock market has felt the brunt of that particular interest hike. Now remember, as we said in one of the videos on Friday Money Matters, that whenever there is an increase in interest, especially of a particular economy, it means that the currency of that particular country is actually benefiting from that. So it means that their money has become a little bit more expensive. So as such, investors will rather put their monies in forex because they stand to gain a little bit much more rather than putting their money in stocks. So therefore, there is a shift and a moving of portfolios, investments moving from one tool to another. In this case, withdrawals from stocks and into forex and other investment tools. The fourth one, but not the least, is geopolitical tensions. Now, for quite a while, we have seen war, rumors of war. Of late, you saw the actions of Israel on Yemen, the long-standing conflict between Russia, the Ukraine, and the whole instability that is happening in the Middle East adds to this uncertainty in the market. And as long as there is uncertainty, then in most cases markets will crash. We have seen, therefore, that investors are becoming a little bit jittery as far as putting their monies in stocks, opting for other avenues. We'll put a video on which avenues are being exploited in this particular economic environment. Please be on the lookout for that particular video. If you have made it this far into the video, please consider subscription to the channel. We'll greatly appreciate your support. So then, what do you do in such a market? What is the solution? How do you place your investment portfolio to make the best out of such uncertainty in the market? Now, first things first, I've said this over and over, and I'm saying it again in this video. The key in the investment game is diversification. Diversify. Putting all your eggs in one basket is a dangerous thing to do. If that particular sector in which you have invested crashes, it means that you lose everything. So spreading your equity across many different sectors ensures that when one sector is down, you are still making good gains from other sectors. Therefore, please diversify your investment. And the next strategy that you can adopt is invest in bonds. Now, bonds are one of those safe havens, especially when it comes to investors that are looking for a fixed term period in investments. Now, if you are investing in bonds, you are basically, for instance, let me give an example of a government bond. If you're investing in a government bond, you are borrowing the government your money, and then it comes back to you after a fixed term with interest. Okay, so the reason why this is safe is because, one, your government will not go anywhere. Your government will be there, and if there are any delays, again, it's more interest to you. And again, it's safe because you are assured when it will come, you are assured how much they will pay, and therefore it is better to invest in such investment tools compared to others. Of course, you might find that the returns will be less compared to others, but if you are an investor who's trying to avoid risk, you are more risk averse, it is advised that you go into safer investments such as bonds. The third strategy, and this is a must, is that you stay informed. Find out exactly what's happening in the markets, get to know your financial news, business news, read some journals, and follow what is happening in the market on a day-to-day basis. Now, doing so ensures that you are able to identify opportunities as and when they occur, and you're also able to avert the risk when it's about to hit the market. Now, imagine if you knew exactly that the market was going to go into a massive global stock sell-off. You would have positioned yourself to move out of that particular market and move your equity elsewhere. So it is very important for you to stay informed in this very volatile market. Consider dollar cost averaging as a fourth investment strategy. This strategy allows you to invest a fixed amount regularly, reducing the impact of the market volatility. Now, a lot of people don't know about this, but putting smaller amounts on a regular basis in order to increase your portfolio is seen somehow as a strategy of being sort of on the edge of things. You are right on the knife edge of things, meaning that you still have got equity or liquid capital that you can be easily moved elsewhere in the case of a massive impact as we have seen recently. Okay, lastly, I need to emphasize that in such circumstances, it is very important that you remain calm, right? Moving your investments in a haste, you might find yourself moving into more riskier avenues. Therefore, stay calm, and when you make a decision, be sure that the decision that you're making is a strategic one. And also, please consider long-term investments, because like I said earlier, that markets are cyclical in nature. Every downturn will come to an end, and soon enough we'll see recovery and then expansion, and then we go into a boom phase. So always consider that in a downturn or in a sell-off like this, there are also great opportunities to buy stocks at very low prices. The game is buy low, sell high. Now, be looking for opportunities so that you can buy whatever equities or stocks right now, because it's like they are on sale if they're at their lowest. Therefore, always go against the market in such a scenario. Look for investment opportunities, especially now when everyone is in the panic. I really hope that you are going to position yourself much better in the future, so that we can all avert such circumstances and make the best out of any cyclical turns in the market. This is Money Matters. We'll see you next time. Thank you for tuning in. Please do subscribe. Bye bye.